Hello, welcome to the 28th lecture of the course Forex in 3 steps. Now that we have completed the classical technical analysis in trading, let's jump into the more advanced things. The first thing we want to talk about is risk management in trading. Risk management is huge and it is a very important factor in trading, which will differentiate between the winners and the profitable traders and the losing traders. If you are unable to stay disciplined and always have your risk management in check, you will be losing your money in trading. There are some rules in risk management that is general in trading, and there are other rules that we will talk about that of course you can choose which to follow and which not, but they are all important and they are all very important to understand. So let's get straight into it. Risk management. Risk management is the process of setting a set of trade management rules to ensure that any negative risks to the trading account are studied and calculated. Risk management plays an important role in the trader's psychology and the success rate of the trade. The world's top traders use risk management strictly. So again, risk management is all about calculating and studying everything that may happen to your trading account and studying and forecasting all the risks and accounting them. It is also about staying disciplined and following your strategy strictly and never ever being emotional and start revenge trading and forgetting everything about risk management and everything about position sizing and just entering the market with everything you got. This will cause you to lose your account. Some of the basic rules of risk management are: firstly, understanding the market and what you are dealing with, focusing on specific currencies or commodities. Just like we stated in the start of the lectures in the course, each market move in a different way. Some markets are volatile, some markets are slow, some markets move during times differently, and some others move at different times differently. So the first thing you need to know during risk management, and in order to have great risk management, which is a key aspect if you want to succeed in this industry, is being able to identify and being knowledgeable of knowing what you are dealing with. What is the market you are trading like? How does it act? How does it move? How volatile is it? How risky is it? The second thing in order to have great risk management is to build a strong and well-studied trading plan or strategy. Because risk management is all about a set of rules that you set for yourself and you set inside your strategy in order to perform well in the financial markets. So in order to have good risk management, you need to be able to have a well-studied trading plan that you are willing to stay disciplined and follow and trust for the time you are trading. The third thing, and one of the most important things in risk management, is not risking more than 1% of the account value on each trade. What does this mean? It means that, for example, if I have an account with a balance of $100, so I have a trading account with $100 that I want to trade with, I only risk $1 per trade. And yes, I know this may seem like nothing, but you need to implement this rule in your trading strategy if you want to succeed. Risking only 1% per capital or 1% of your whole capital in trading will prevent losses and will prevent blowing your account and getting liquidated. It will also mean that you need to lose over 100 trades in order to lose your account. And to be honest, if you have a good strategy and a profitable strategy and you are disciplined and you can manage your emotions well, you should never reach even 10 or 15 trades losses in a row. Some people may get unlucky and they may enter the market at times that are very difficult, which may cause a losing streak, but it should never reach more than 10 losses in a row. Losing only 1% per trade will allow you to have good discipline, and you will be able to manage your emotions better, because losing more than 1% of your account in one trade may cause you to lose confidence in your strategy. It may cause you to lose your emotions and start revenge trading, which may cause even more severe losses to your trading account. I can't stress it enough, but risking 1% of your capital per trade is very important. Some people risk different amounts of money on different types of trades. So for example, if they see a very good trade, they may increase the risk to 2% instead of 1%. This is a very big mistake. Please do not do this mistake, because it is very normal for in trading that you may see a very nice setup, you may see a very nice trade that you are willing to increase the risk for, and you may still end up losing the trade very normally. So if that happens, let's say for example you decide to risk 2% per a trade which was very good, but you ended up losing it, which is very normal, so you end up being down 2%. The next trade you enter normally with only 1% risk, and you end up winning the trade with a 2 risk to reward ratio. So you have a nice profitable trade, and you make twice the amount you risked. But at the end of the day, you will find yourself at break even though you won a trade and you lost a trade. But sadly, the trade that you lost was you risked more than you should have, and therefore you lost 2%, even though you won them at the end, but you did not come out profitable at the end of the day. And sometimes this is very annoying, because you should be able, when you win a trade and you lose a trade, you should be coming out of this day profitable. Your profitable trades or your winning trades should be much more than your losing trades. And that is why I do not recommend you to be changing the risk you risk per trade. So commit to a percentage. I would recommend using 1% of your account, only risking 1% of your account per trade. But if you have a low capital and you want to increase this amount a little bit, you may start using 2%, but I would seriously recommend using 1%, especially for beginners. And no matter what, stick to this percentage no matter what. The last thing I wanted to say is the formula for managing risk and allocating the risk size. So the formula you need to calculate the lot size is lot size equals capital, so the amount of capital you have, times the risk percentage, the amount of risk. So for example, in my case, I use 1%. Then you divide this number with the stop loss amount times the pip value. This will give you the lot size you need to enter the trade and risk the 1% of your account. And lastly, of course, the most important thing with risk management is always having a stop loss. And no matter what, never move your stop loss. Your stop loss should always be at strong highs or strong lows, and somewhere that is not near liquidity, so you do not get stop hunted. We will explain everything later on in the course, but for now, never move your stop loss, because moving your stop loss means that your risk is greater and you will start losing more than 1% that you risked at the beginning of the trade, and this is a very bad habit. So do not get used to it, because it is very hard to get out of it as soon as you start doing it. And trust me, when you start moving your stop losses, the losses will only get bigger, and it is rare that price will reverse before hitting your stop loss and losing your whole account. That is it for this lecture, and I'll see you in the next one.